something is happening in the American housing market right now that almost nobody is talking about loudly enough. Not loudly enough in the news, not loudly enough in the financial press, and certainly not loudly enough in the conversations happening at kitchen tables, in break rooms, and in the comment sections of every real estate post you've scrolled past this year. Google searches for the phrase "can't sell house" just hit an all-time high, surpassing levels seen during the 2008 financial crisis, surpassing even the completely frozen lockdown market of 2020 when nobody was buying or selling anything. More people are typing those words into their phones right now than at any other recorded moment in American history. And yet, the mainstream conversation is still quiet. The headlines are measured, the real estate industry is using careful language, the economists are hedging, and the average American is being told more or less that things are fine, that it's just a reset, that the market is normalizing. But what if it's not normalizing? What if what we're watching is something we've seen before, just wearing different clothes?
That is the question we're going to answer today. And I want to be very clear before we go a single step further. I am not here to scare you. I am not in the business of doom. I don't benefit from panic, and I don't think panic is useful to anyone trying to make real financial decisions about their lives. What I am here to do is look at the data honestly, compare it honestly, and give you a framework for thinking about what's happening and what might happen next that you can actually use. Because the patterns between now and 2008, they're close enough to deserve serious attention, and you deserve to understand why. Let's start at the beginning. To understand where we are in 2026, we have to go back and understand where we were in 2008, not just in terms of what happened, but in terms of how it built, because that's the part people always forget. The crash of 2008 didn't arrive as a surprise to everyone paying attention. There were warning signs. There were people sounding alarms. The problem was that the alarms were ignored or drowned out by the noise of a market that had convinced itself it could only go up. Sound familiar? Let's walk through it. The seeds of the 2008 crisis were planted years earlier, deep in the early 2000s, in the aftermath of the dot-com bust and the September 11 attacks. The Federal Reserve, trying to stimulate a struggling economy, slashed interest rates dramatically. Money became cheap, really cheap. And when money is cheap, lending becomes easy. And when lending becomes easy, standards start to slip. Mortgage lenders, no longer just banks, but also unregulated brokers and non-bank financial institutions, began issuing loans to people who, by any reasonable standard, could not afford them. We're talking about subprime mortgages, loans given to borrowers with poor credit histories, no savings, inconsistent income, sometimes no income at all. These were the infamous ninja loans, no income, no job, no assets, and they were handed out at an extraordinary scale.
And here's the part that made it a systemic crisis rather than just a lending problem. Those risky mortgages were packaged together into complex financial instruments, mortgage-backed securities and collateralized debt obligations, and sold to investors all over the world. The risk was spread so widely and so obscured by financial complexity that almost nobody truly knew how exposed they were. Builders, responding to what looked like unlimited demand, started constructing homes at a furious pace. Between 2002 and 2006, housing starts hit levels not seen since the 1970s. Supply flooded the market. Prices were rising, in some cities doubling, tripling, and the expectation that they would never fall became a cultural assumption baked into the entire financial system. Then, the adjustable rate mortgages started resetting. The introductory teaser rates expired, and monthly payments jumped, sometimes by hundreds of dollars overnight. Borrowers who could barely afford the low rate had absolutely no chance at the reset rate. Default rates started climbing. The loans at the bottom of the financial pyramid began to fail, and the whole beautiful, terrifying structure started to shake. In 2007, the cracks became visible. By 2008, they became chasms. Foreclosure filings hit 3.1 million in a single year. Home prices fell more than 25% nationally, as measured by the Case-Shiller Index. In places like Phoenix, Las Vegas, and parts of Florida, prices dropped by 40, 50, 60%. Major financial institutions, Lehman Brothers, Bear Stearns, Washington Mutual, collapsed or had to be rescued. The stock market lost more than half its value. Unemployment climbed to nearly 10%, and the United States entered the worst economic recession since the Great Depression. That is the baseline. That is what a full-scale housing market collapse looks like, and that's the yardstick we're going to use as we look at what's happening right now. Now let's talk about 2026, and let's do it the same way, with data first, context second, and opinion only after the evidence has been laid out. The first number that should get your attention is 600,000. That is the approximate gap between the number of home sellers and home buyers in the United States as of early 2026. A January report from Redfin found that sellers outnumber buyers by roughly 600,000, a gap of about 44%. There are almost half again as many people trying to sell homes as there are people in a position to buy them. Now here's the critical nuance Redfin themselves flagged. This is technically a buyer's market, if you can actually afford to buy. The problem is that the pool of people who can afford to buy has shrunk dramatically. High home prices, elevated mortgage rates, stagnant wage growth, and broader economic anxiety have pushed potential buyers out of the market entirely. They're not waiting on the sidelines watching for the right moment. Many of them have simply given up. And the data bears that out. The number of U.S. homebuyers fell 8% year over year in early 2026, dropping to approximately 1.36 million. According to Redfin's own estimates, that is the lowest level of home buying activity ever recorded in the United States. Ever. Not the lowest since 2008, not the lowest since the pandemic, the lowest on record. The next number, 53%. That is the percentage of American homes that have lost value over the past year, according to Zillow data. More than half of all homes in the country are worth less today than they were 12 months ago, with an average decline of nearly 10%. That means if you bought the median American home a year ago at $410,800, it is statistically likely worth somewhere around $369,000 today. That's a paper loss of more than $40,000, wiped out in 12 months. Then there's the 22 cities figure. A Realtor.com forecast released in early 2026 projected that 22 of the 100 largest cities in the United States would see further home price declines throughout the year. Nearly a quarter of America's biggest housing markets are expected to fall, not hold, and certainly not rise. And then, and this is the one that keeps coming back to me, there is that Google search data. Searches for can't sell house at a level higher than 2008, higher than COVID. Think about what that means. Real people sitting at their computers or looking at their phones at their wits' end typing that phrase. Not how to sell house faster, not home selling tips. The raw, defeated phrase, can't sell house. That is not a market searching for optimization. That is a market in distress.
Let's dig into the root cause of all of this, because it's important, and it's where the 2026 situation diverges from 2008 in a meaningful way, even as it arrives at a similar destination. The 2008 crisis was, at its core, a supply of credit crisis. There was too much money available to too many unqualified borrowers. The problem wasn't that homes were unaffordable. In many ways, they were made artificially affordable through irresponsible lending. The problem was that the affordability was fake. It was borrowed time, literally, and when the clock ran out, the crash came. The 2026 situation is the mirror image. Credit is tighter, lending standards are stricter. The problem isn't too much access to mortgages. It's that homes have become genuinely, structurally, and possibly permanently unaffordable to a vast swath of the American population. Let's look at the numbers in detail. The median home price in the United States reached $410,800 in the second quarter of 2025. Over the past decade, home prices have risen by approximately 42%. That's a 42% increase in the cost of the asset over 10 years. Now look at income. Median household income in the United States sits at approximately $83,730. Over the same decade, wages have grown, but nowhere near 42%. Real wages, adjusted for inflation, have barely kept pace, or in many demographics have fallen behind. Here's what makes this concrete.
To comfortably afford a median-priced home using traditional mortgage guidelines, keeping your housing costs at or below 28% of gross income, you would need to earn approximately $118,530 per year, according to Realtor.com's analysis. The median household earns $83,730. That is a gap of nearly $35,000. $35,000 of annual income that the median American family simply doesn't have. And unlike 2008, when you could paper over that gap with a ninja loan, today's lending standards mean that gap is real, and it shows up in the data as a missing buyer. Housing analyst Melody Wright has been one of the most vocal voices on this. She argues that the housing market needs to correct all the way back to a point where median household incomes are meaningfully aligned with median home prices. And she has said, plainly, publicly, with data to back it up, that this correction, when it comes, will be worse than 2008. Her reasoning is not hysterical, it's mathematical. If incomes have not risen to meet prices, and if prices cannot sustain themselves without the buyers that artificial credit used to manufacture, then prices have to come down. The only question is how fast, how far, and what triggers the move. When a fundamental asset class, the thing millions of families rely on not just for shelter, but for the majority of their net worth, becomes permanently disconnected from the income of the people it's meant to serve, you have a structural problem, not a temporary imbalance, a structural problem. And structural problems don't resolve themselves gently.
There's another layer to this story that rarely makes it into the mainstream conversation. It has to do with who has been quietly propping up the housing market since 2008, and what happens when they stop. After the crash, as prices bottomed out in 2011 and 2012, a new kind of buyer entered the market in force. Not individual families, not first-time homebuyers. Wall Street. Large institutional investment firms, companies like Blackstone, Invitation Homes, American Homes for Rent, and others, swept into distressed markets and bought single-family homes by the tens of thousands. In some neighborhoods, in some cities, they bought entire blocks. They converted owner-occupied homes into rentals. They became, almost overnight, some of the largest landlords in American history. Now, you can debate the social and ethical dimensions of that transformation all day, and many people do. But what's undeniable is the market effect. It put a floor under home prices. When institutional money was buying every distressed property in Phoenix, Las Vegas, and Atlanta at scale, prices couldn't fall as far as they naturally would have. The market was being supported from below by capital that had no emotional attachment to homeownership, capital that was purely return-driven. Melody Wright, and she's not alone in this analysis, argues that in 2026, that floor may not hold. Here's why. The math of owning single-family rentals has gotten significantly worse over the past several years. Property insurance costs have surged in many markets, particularly in the Sunbelt states that saw the most institutional buying, driven by climate risk, natural disasters, and insurance market retractions. In Florida, in Texas, in parts of California, insurance costs have doubled, tripled, or in some cases become simply unavailable. Property taxes have risen as assessed values climbed, maintenance costs have increased with inflation, and critically, rent growth has not kept pace. The rent increases that institutional landlords were banking on have slowed. In many markets, rents are actually falling as the supply of rental units has grown. The result, portfolios that looked like gold in 2015 or 2018 are looking a lot less attractive in 2026. The cap rates, the return on investment, have compressed, and when returns compress, institutional money looks for the exit. If institutional investors go from net buyers to net sellers, if they start offloading inventory rather than accumulating it, the supply impact on an already oversupplied market could be significant. Wright specifically warned that this dynamic could cause values to fall faster than in previous cycles, because these properties have often been maintained at minimum standards and will hit the market in quantity, not individually. This is not a prediction, it's a risk factor, but it's a risk factor that barely gets discussed. And it's worth noting, this concern isn't limited to fringe analysts. Treasury Secretary Scott Bessent said in early 2026 that the housing market is already in a recession, specifically using that word, recession, attributing it to Federal Reserve policy that has kept mortgage rates elevated for longer than the market anticipated. When the Treasury Secretary is describing the housing market as being in recession, we should probably be paying attention.
So let's do the direct comparison. Two markets, separated by nearly 2 decades, viewed side by side. In 2008, home prices were severely disconnected from household incomes. The affordability gap was papered over by irresponsible lending. In 2026, home prices are severely disconnected from household incomes. The affordability gap is exposed by the absence of that lending.
In 2008, seller supply exceeded buyer demand at a massive scale, driven by foreclosures and panic. In 2026, seller supply exceeded buyer demand at a massive scale, 600,000 more sellers than buyers, driven by an affordability wall that potential buyers cannot climb over. In 2008, distress-related Google search terms spiked dramatically, acting as an early warning signal before official data caught up. In 2026, can't sell house has hit an all-time high, higher than 2008 itself, signaling stress in real time. In 2008, institutional and speculative buyers eventually came in to absorb the supply glut and put a floor under prices. In 2026, institutional buyers are signaling retreat, potentially removing the floor that cushioned the last correction. In 2008, public sentiment moved from euphoria to fear. The transition was fast and brutal. In 2026, public sentiment has moved from the pandemic-era housing fever, when people were paying 20, 30, 50% over asking price, to a paralysis where neither buyers nor sellers know how to move. And in both 2008 and 2026, the market is frozen, just for different reasons. In 2008, it was frozen by foreclosure and default. In 2026, it's frozen by the lock-in effect. Sellers who bought or refinanced at 3% mortgages and refuse to trade that rate for today's 7%, and buyers who can't qualify or can't afford the monthly payments those rates require. The mechanisms are different, the root causes are different, but the output, a market under profound stress, failing to perform its basic function of allowing people to buy and sell homes, looks remarkably similar.
Now I owe you the other side of this argument, because intellectual honesty requires it, and because the people making the counterargument are serious, credentialed, data-driven economists and analysts who are not wrong to point to the differences. The first and most important difference: the quality of today's mortgage borrowers is dramatically better than 2008. This is not a minor point. In 2008, the system was loaded with subprime loans, mortgages given to people who were essentially guaranteed to default when conditions changed. Today, those loans essentially don't exist. Post-2008 regulation, including the Dodd-Frank Act and the Qualified Mortgage Rules, transformed lending standards. The people who have mortgages today, by and large, actually qualified for them. Their credit scores are higher, their down payments are larger, their debt-to-income ratios were actually verified. The foundation of today's mortgage market is vastly more solid than 2008. The second major difference: foreclosure rates are not at crisis levels. Yes, foreclosure filings have been rising. A roughly 19% year-over-year increase in late 2025 sounds alarming, but context is everything. 36,000 monthly filings is a tiny fraction of the 3.1 million annual filings at the peak of the 2008 crisis. Mortgage delinquency rates, the percentage of borrowers behind on payments, remain near historic lows. The wave of forced selling that characterized 2008 is simply not present in today's data. Third, the rate lock-in effect that's freezing the market is also protecting it. This is a paradox worth sitting with. The fact that more than half of American homeowners have mortgage rates below 4% means they have a very powerful financial incentive not to sell. They're not going to default. They're not going to be foreclosed on. They're going to stay in their homes, maintain their equity, and wait for rates to come down. This suppresses inventory, which keeps downward price pressure limited. Fourth, and perhaps most importantly, we are undersupplied, not oversupplied. This is the structural counterargument that most housing economists lean on. In 2008, the crash was partly fueled by massive overbuilding. Too many homes were constructed in anticipation of demand that evaporated. The excess supply crushed prices. In 2026, the situation is reversed. America has been underbuilding for the better part of 15 years. Zoning restrictions, construction labor shortages, permitting delays, and the legacy of 2008 itself, which put many builders out of business and scared the rest into caution, mean we have a genuine housing shortage. Most estimates put the national deficit somewhere between 3 and 5 million units. You cannot have a supply-driven price collapse in a market that is fundamentally short on supply. These are the arguments that lead Zillow to forecast a modest national price increase in 2026, that lead Redfin to project more home sales this year, not fewer, that lead the majority of mainstream housing economists to call this a period of adjustment, a painful plateau or modest correction, rather than a crash. And they might be right. I want to be clear about that. A 2008 scale collapse, prices falling 25% plus nationally, millions of foreclosures, systemic financial contagion, is not the base case scenario for 2026. The structural safeguards built after 2008 are real and they matter.
So where does that leave us? What is the honest, balanced, evidence-based view of where the housing market stands in 2026? Here it is. We are not in 2008. The mechanisms are different, the lending quality is better, the foreclosure threat is lower, and the supply dynamics, while complicated, do not mirror the overbuilding that amplified the last crash. But we are in a housing market that is under genuine, significant stress, and that stress is not temporary, it is structural. It is rooted in a decade and a half of home prices racing ahead of wages, of monetary policy that created a speculative environment, and of a housing supply system that consistently failed to produce enough homes for the population that needed them. The result is an affordability crisis that is in many ways worse than anything we saw before 2008. Then the affordability problem was masked by bad loans. Today it's naked, visible, undeniable, and it's hitting working and middle-class Americans the hardest. The 53% of homes losing value, the all-time low in homebuyer activity, the 600,000 seller surplus, the record Google searches, the Treasury Secretary using the word recession. None of these are artifacts of media sensationalism. They are data points from credible institutions describing a market that is not functioning normally. And the uncomfortable truth is this. Even if we avoid a 2008-style catastrophe, even if prices correct slowly rather than crashing, the human cost of that correction will be enormous. Millions of people who bought at peak prices in 2021 and 2022 are sitting on shrinking equity. Millions of first-time buyers who stretch their budgets are at risk if rates don't come down or if economic conditions worsen. And millions more who have been priced out entirely are facing a rental market that is also strained. Higher rents, lower vacancy, and in many cities, conditions that are genuinely crisis level. A slow grind down is not a gentle outcome. It's just a slower, painful one.